going to talk about. I'm like, oh, cool. I can't wait to hear. So Sean, we're so happy you're here today. Pleased to see you and hope that everything is going fabulous in your world. And tell us what's going on, my friend.
Excellent. Quite the intro. As always, Carol, thank you so much. So yeah, what's going on in the world of mortgage? I always just want to start out and lead these sessions with the basics information. Like, if you guys have questions or you're dealing with something in the market right now, raise your hand. Put in the chat box what it is. If you have a question, do that as well. I'm going to go through it real quick, but there's some changing information in mortgage as usual. But if you haven't heard about it yet, there are some pricing changes coming in comparison to primary and second homes, but then also second homes and investment properties. So what is happening right now, or how it was set up in the past, is you could pretty much get you could get a primary residence loan and a second mortgage, second home loan, or a vacation property for basically the same rate. Let's say they're both 3%. The primary residence and the second home are the same price, but the loan to value minimum requirements are the only differences. So primary and second homes used to price the same, and then we know investment properties, the 80% loan to value are higher interest rates than they are at 75% loan to value. Okay, so the change and what's changing is what's going on with the bank's liquidity levels and the percentage of their portfolios that are second homes and investment properties. So what they said is that they only want you to have a certain limit of investment properties and second home loans in your portfolio. And if you have too many of those, you're going to have to sell them off and rebalance the portfolio. So what the banks did in response to that, well, if we can't have that many of them, then we're going to need to charge more on them, and we're going to have to spread it around. So you guys will start seeing, if you haven't already, a small increase on second home pricing, which is definitely a new thing. Interest rates are up and have been up about 3/8 to 0.5% in the last 7-8 weeks. But this is on top of that as well. So, I mean, I'm pricing a 10% down second home, at like 3.5 right now, and a primary residence is like 3% to 3.25. So it is a little different. Investment properties have gone up as well, just a little bit, but about an eighth in rate, I would say, over what it used to be. Still not bad. Rates are still in the mid 3s. Let's put it in perspective. Rates under 4 are still phenomenal. We didn't even think they'd get to under 3. But I'm sure what some of your clients are feeling, and if they're running some numbers a few weeks ago, the numbers for the same price are more expensive. And because it's hundreds of thousands of dollars, it's $200 to $400 a month more. And so people are thinking about it more as well. So that's it in a nutshell, but I want you guys to be prepared for it, because I want you to be able to talk about what's happening and the impact it's having with your clients. So with that, pretty basic information. Let's see, what else is going on? Some people in the waiting room.
I got him. So Sean, regarding that, do you really think it's gonna, for you anyway, is that gonna be a big, like you said, put it in perspective, we're still talking about that mid 3 range. Is that really gonna be a huge?
It's not. What it is right now we're trying to get people off the fence, and I think I said this last time.
Yeah.
We want them to think interest rates are going up. We want them to get the best deal. This is good for the economy, and what I think is actually going to happen, and of course the banks would do this, rates go up this year, they stay here or plateau here, and at like 3.5, 3.6. And then next year, this time, we're going to refinance it all again. Because we're the bank and that's what we're going to do. So we'll get all the purchases this year and then we'll have a nice little refi boom again next year when rates, I'm told rates should be down lower than they were before. I don't know how low they're going to go under 2.5% on a 30-year, but what I saw before rates went up was some massive rebate pricing or massive lender credits towards closing costs at like 2.6 to 2.75. So I think it's going to be more like that, where you're going to be able to get all of your fees covered and everything, and you're still going to be able to save money. We are seeing appraisal waivers go away a little bit more. That's been a hot topic for at least 9 months, at least a year, actually. This is going on a year. Fewer properties are qualifying for them. Oh, here's another huge thing. Guys, desktop underwriting, AUS, just changed their requirements. So with this, with the compounding factors of this, the portfolio balance is also coming changes in the DU for layered risk. What that means is if you have a bad credit score, a high loan to value, a low down payment, marginal credit, and weak reserves, normally we would have an approval up to like 49% on their debt to income ratios. Sometimes we get it at 45%. But now we're seeing that even if we go down to 32% debt to income ratio, sometimes what used to get approved is no longer getting approved. It's really weird. I used to be able to know before the approval ran if it would work or not. And now I'm having Mercedes run every single one of them because we just don't know. I don't know what the model's saying or what it's going to spit out. And it might also be that IRLA, the new mortgage loan application, might be an impact of that and some of the fields not going together. But it's interesting. New layered risk is going to kick out some of these deals. And some of the deals that were pre-approved 2 weeks ago, if they rerun that, the layered risk might be in there now and it may not qualify. So that's a big deal. Has anybody heard that or had a pre-approval that's changed after the fact like that?
Go ahead and feel free to
Hopefully
unmute
not.
yourselves. We've only got a small group here of about 15, so 14. So feel free to unmute yourself if anybody wants to chime in here.
Jason, what are you seeing out there? Interesting changes, yeah.
Well, hey, Sean, I haven't seen anything related to that, what you just talked about as far as the layering goes, but I'll keep my eye out for it.
Cool. I'm sure you're still seeing a ton of cash.
Oh, yeah.
Yeah.
It's crazy out there.
Yeah. They're still doing, for self-employed borrowers, they're still doing this interesting cash flow analysis, even on conventional loans. Normally, you would only have to get a balance sheet and liquidity verification on jumbo loans, loan amounts over 550. But because of some of these changes, with COVID, they're actually requiring us to see 3 months of business bank statements, which they've never required that before. But they're also reviewing that to make sure it matches up with the profit and loss statement, the year-to-date profit and loss statement. So let's say your business is cyclical and most of it happens in June, and you don't have a lot of deposits in January, February, or March. They're not going to be able to probably get through unless you wait until that cash flows back up, that seasonality is through, and you can kind of show that year-to-date situation with the deposits. I mean, it's really interesting, all these changes they made for COVID, but it's actually kind of some make sense underwriting to a certain extent. I don't know that I necessarily agree with it. They are tightening the belt a little bit, well, a lot, but it's still a good idea to review this stuff, because if our clients don't have the liquidity, if their businesses are not on the upswing, then we need to make sure that they're in a good spot and not putting themselves in a bad spot. So I mean, my motto always is, just because we can get the deal done doesn't mean we should always do the deal. It all depends on what is best for the client.
Hey, Sean, is there any update you might have on the, as far as how COVID is affecting things with the forbearance, loan forbearance, and then repackaging them and maybe loan modifications? I know you touched on that a few weeks ago, maybe a month or.
There continues to be more information coming out about it. And I'm sure you've seen some of the headlines. The forbearance portfolio they thought was performing is not performing that well. There seems to be an attitude like, oh, you let me skip my payments, I'm just going to continue doing that. Well, that's kind of a bad model. We need everybody to make their payments. What I am seeing is that if you were deferred for 3 months and you're caught up for 3 months, you can get approved for a new purchase or a refinance. If you were deferred for 5 months or 6 months, you have to have that many more payments caught up to verify your credit history for that situation. There was a contract, I saw something recently. I think it was, if you guys don't tune into National Real Estate Post, I think it was on there last week. They were talking about the recession and the differences between loan modifications and the loan modifications between 2008 to 2012, and then comparing that to the number of units that went on deferral. The numbers are like 50 times higher. And it's unbelievable. So if that many people aren't making their payments, when will they start making them again? Will they continue to make them on time? Will the banks continue? How long are they going to allow that to happen? And every bank is handling it differently, however they want to. So I would get all of the agreements, review them with your clients if they're reaching out. Hopefully they are. But I would really encourage them not to go through with it if they don't have to. It's going to get weird in about 6 to 12 months.
You just answered my question
How
by
is that
saying it's going to get weird in 6 to 12 months.
I mean, I was saying that last year. I was saying it was going to be about 18 months to 2 years.
I know. I've been asking you about that crystal ball for a while now.
It all depends on how quickly the states also allow people to foreclose. Does anybody know right now what the tenant occupancy requirements are? I mean, can we get anybody out of their homes right now if they're foreclosed on? Or rent tenants if the owner forecloses on the property? Is it a 90-day notice? What are the new changes for California? I don't deal with tenant occupancy a lot.
Sean, I don't deal with it either. I know that on a federal level, the CDC kicked the can down the road, and I think that the counties vary from county to county, because you not only have the state laws, but then you have county laws, some cities. So I was actually trying to dig into that and figure that out. I'm just not quite there yet.
Right.
It gets complicated. And the reality is that even if you wanted to evict somebody right now and you were to file an eviction action in court, the courts, remember, were shut down for a long period of time, and
Exactly.
So they weren't hearing cases really of any type for months. And so you've got a long backlog of those cases. So if I was a landlord, I would probably be trying to work something out, at least
Right.
for now, unfortunately.
Right. And then I mean, I have another owner that I've been working with. He has 23 units. And none of his tenants missed a beat. So, I mean, I don't know. I think it all depends on who the tenants are, what kind of reserves they have. And again, I think we're going to see a lot of family consolidation. If you haven't been on every single one of these, I think I mentioned I'm going through it as well. We've got my father-in-law living with us. So yeah, everybody's going to consolidate. But what that means is if the family wasn't able to make their payments on their own, by consolidating, they're bringing other incomes in, and maybe we're living on top of each other temporarily. But again, I think the reason why I say it's going to get weird is because yes, there should be more trouble, but the affordability is so good. As I've been saying over the years, we've been full doc underwritten for 10 years. We have the lowest interest rates we've ever seen. People are going to scrap to keep the payments as low as they are because $1,500 is $1,500, and people want to get a payment of $1,500 to $2,000 a month. I hear it all day. You know what? Probably not going to find it. We're $2,000 to $2,500 a month now. So they can't go anywhere. They can't rent for less, and most of them already have equity. We've been writing equity for how long now? Like 7 years, 10 years? I mean, if you bought right. And we're basically back at what, 100% of value of where we were at pre-recession, give or take, maybe 5%. It's just kind of interesting. So the point is, I think fewer people are going to go into default than we expect, but it all depends on when people are going to go back to work. And I'm sure you guys hear all kinds of stories. Well, it doesn't make sense for me to go back to work if they're paying me unemployment more than I'll make. So some interesting attitudes out there.
Yep.
So Sean, are they making people catch up on their payments, or are they just tacking them on the back of the loan and restructuring the loan? Do you know, or does it just vary depending on the bank?
They're doing all kinds of things. They're doing term extension, where they're putting the payments on the back of the loan. Some of them are extending it to a 40-year term, which will draw out the interest even more, pay the bank even more. What they're doing on those payments, though, is they're also reporting it as past due amounts. So it really freaks all the borrowers out because it looks like it's all past due, like $10, $12, $15,000. But yeah, some of them are just tacking it onto the loan. Some of them are doing a complete restructure. Like I said, every bank's a little bit different. I've seen a couple. Yeah, I talked to a lady last week. They were doing a 40-year loan mod. So they got a 40-year term, but they decided not to take it because they can make the payments. Imagine that.
That's great. And by the way, can I get the name of your interior designer, by Sean, behind you?
Yeah, her name's Paige. Paige Maceo.
Looks pretty good.
She was a great designer, by the way.
Nice.
Jumbo financing, we still got great jumbo money, 10 to 20% down on primary residences, second home 15 to 20% down, and then I'd recommend 20 to 25% down. We can go up to, on investments, we can go up to about 2.5 million if you need a loan amount that big. We can do that. And I'm even working on some commercial loans right now as well. So not that a lot of you are into that, but we do that as well. And having a lot of fun with private money lately too.
What kind of rates on a jumbo, Sean?
Rates on the jumbo are like 3.1 to 3.3.
Okay.
Lots of good programs there. Tina, what are you seeing out there? You getting your condo sold? Did that flood thing ever change?
Hold on, can you hear me?
Yeah. Oh, we could, and then I think you muted it.
Can you hear me now?
There you are. Hi.
Okay, sorry. No, I was just saying, yeah, flood, no problem. It's just the problem is inventory and getting people to list. That's our challenge.
Yeah. So is everybody doing the texting challenge? Are you doing the texting challenge, the 30-day?
I'm not doing it, but we were already texting people
You guys are all
that had second homes. That's what we're focused on right now. Seeing if they want to sell.
So let's talk
But-
about that. So let's what are some of the common objections you're hearing right now?
Well, one thing that I need to educate myself on is that new law that took place. One of the objections we had was tax related, but I know that there's a new law that took place, I believe April 1st.
Is that
That had
like a
to
Prop
do-
90, Prop 60?
Yeah, and I'm not familiar with it. I need to educate myself on that. So we're working on that to go back to that particular owner. As far as typically, if it's their primary residence, it's where are they going to go? There's, you know, it's multiple offers. Prices are up, even though they can sell their home at a higher price.
Right.
Where are they going to move to?
Right.
And they're nervous. That's primarily what I'm hearing. We have, and maybe you can help. We have a new client out of state. He has a broker in Oregon, but we told him that he should look at getting pre-approved here, and he was open to it. So I'll give him your information. But he's an investor. It would be conventional 20. He's got 20% down. But we haven't talked about this new law that you're referring to as far as the increase in the interest rate. So I don't know if he's aware of that.
Yeah, and it's not a law. It's just like a bank overlay. They're just kind of pricing it in a little bit differently. But yeah, and 20% down on the investment properties is going to have a slightly higher rate, probably closer to the 4s compared to 25% down, which should be closer to like 3.5 to 3.6 probably.
And that wouldn't be a problem for him. They could do that.
So
The
great,
problem is finding he's looking for a vacation rental under 30 days. And that's the problem where there's limited properties and multiple offers. We've lost several.
The biggest issue is getting the seller to take the property off the market.
Yeah. Yeah. Any suggestions, anyone out there?
For getting listing?
Yeah, just to get this moving.
I mean, I've been talking about it for a little while, but I think, and maybe they don't even exist right now, but if you're able to get in with asset managers at different banks right now and build those relationships now, that's what I'd be focusing on, because that's where the business is going to be in, 18 to 24 months. And it's like, who do you go to? Those positions may not even exist right now. And there are asset managers at every bank. There's just, how do you get in touch with them?
Right.
So that's what I would figure out, because they're going to start sending out orders for BPOs, broker price opinions, and start setting that up. And it's a bit of a process, but if you're doing the BPOs, you got a really good chance of getting the listings.
Okay.
Good to talk
Well,
to you.
that's a good tip.
Thanks, Tina.
Yeah, you too. You too. I'm in the car. Sorry, I was driving.
No, you're doing great. Tell Mama say hi.
I will. I will.
So we have a couple more minutes. If anybody has any other topics, Sean, do you have other topics on your list, or anybody have questions they want to ask him? We still have a few more minutes.
Well, on the what Tina was just saying, obviously the big problem is, where are these sellers going to go? And that's the big dilemma. So one thing is to get them to get their house on the market, as mentioned, that they can always take an offer and accept an offer contingent on them finding another property. And then when they can find that other property, the deal can go through. They're not bound to have to take an offer just because someone writes an offer. So
True.
that's just, trying to nudge them forward a little bit. One way, maybe there's others, but
I was going to
yeah,
mention that going contingent. It's a tough sell though, right, Tina? I mean,
yes,
if
it
the property's
is.
not
It
listed
is.
already, it's kind of a tough sell.
Yeah, but points for Jason. That's creative. I like it.
I like it a lot.
Turning that around, right?
Well, and
It's worth
then
a try.
Heck yeah.
And then with that contingency, are we having fun with the rent back schedules and the holdovers and timing for closing and yeah, it's logistically, it's a good time.
right.
My sarcasm is thick, everybody.
We love it. Okay, what else as we wrap up?
I want to continue to build the pipeline in your clients and get the work done ahead of time. I know nobody wants to do the work ahead of time, but like I just had a guy, it took him 10 weeks to get me everything I need, and we were in escrow. He just lost his deal, and there's nothing I can do or help him with that, and that's unfortunate, but he wasn't performing, and that's what happens sometimes. Get your information in quickly, and because those approvals are changing over the phone, it might sound like it should be a good deal or an approved deal, but with that layered risk, that new the new model for how they're weighing approvals, if there's too many layers of risk, we run the risk of not getting an approval. So I highly recommend getting the DUs or the LPs up front as you can, because then that'll basically guarantee the credit. You guys have been keeping me busy this month. You guys are doing so great. Really appreciate all the support. Janet, how are the doggies? Doing good? I'm sure they're doing good. They're adorable. We're just having a lot of fun closing loans.
Yes, you're great. I'm sorry, I have laryngitis.
Oh, poor thing. I'm sorry. All right,
No,
well,
but
save your voice.
you're barking for me all day, so don't worry
Good.
about it.
Good,
Okay,
good.
thanks, Sean.
You're welcome. I think pretty much everybody's here either given me a shot or tried me out.
Yeah.
So I can't say that, but look forward to seeing you all again very soon in person. Hopefully we'll be able to do a face-to-face meeting soon.
Exactly. That's got that right. Right, Sean? Well, Sean, as always, you're amazing. You've always got good stuff to share with us, that's for sure. And we love seeing your smiling face and your incredible sense of humor as well. So thank you for bringing it every time. Everyone who was on the call, thanks for being here. And thanks for asking some great questions and participating in some good conversation as well. Sean, we will see you again soon. The rest of you will see you next week. You take care. Bye-bye now.
Bye.
Thanks.
Thank you.
Thanks.